algorithms and nodes have midwifed yet another invention, a line of businesses called financial technology, software-driven financial services like crowdsourcing and Bitcoin, intending to disrupt financial systems and institutions with code that anybody, anywhere can write.
One of the things that the internet has done is just to dramatically lower barriers of entry in many industries. It's just much, much easier to flip a switch and make your product available to people all over the country or all over the world.
People need banking, but they don't necessarily need banks.
Many times the regulator is a little bit behind to catch up with technology.
The 2014 report, Accenture says New York's financial technology sector has grown at twice the rate of Silicon Valley's over the past 5 years.
Frankly, the FinTech innovation seems to be happening where the financial services firms are in the first place. So you see the rise of the so-called Silicon Alley in New York City, the counterpart to Silicon Valley out in Northern California.
The fintech industry is different from the traditional New York City banking industry in that the goal of these companies is to generally make financial services more efficient. After 2008, mortgages became less available, millions of credit cards were revoked, lines of credit dried up, and banks essentially abandoned the small business and student loan markets. This led to a heavy level of financial service regulation, which created a perfect vacuum of innovation in the industry. These regulations forced banks to focus on their back offices and risk management. The lack of innovation by banks paved the way for fintech startups, which began by creating business models that avoided the structural formalities of regular banks. For fintech startups, regulation is loose, as opposed to the traditional financial services sector. A lack of regulation can cause serious problems, though, which is why New York State has begun to address the situation. For example, as of May 2015, digital currency companies operating in New York State that hold customer funds and exchange virtual currencies for dollars or other currencies are required to apply for what is known as a state BIT license. BIT license rules include consumer protection, anti-money laundering, and cybersecurity protections. However, applying for the BIT license is an expensive and difficult process. Some firms have chosen to abandon the New York market entirely, rather than comply, such as the digital currency company Shapeshift.io. So although these regulations might be incentivizing certain companies to leave New York, they have sound reasons behind them. One of the largest cryptocurrency scandals occurred at Mt. Gox, a Bitcoin exchange based in Tokyo, Japan.
Hey, this is Annie for D-News. Mt. Gox, once the world's largest Bitcoin exchange, abruptly shut down on Monday following a reported theft of over 700,000 Bitcoin, leaving many Bitcoin users feeling cheated and others wondering if this is the end for the digital currency.
In New York, the guidelines for this regulation ask digital currency businesses to keep track not only of the physical addresses of their customers, but also anyone who sends their customers money using the network. This undermines the fundamental value proposition of Bitcoin, which works very much like the internet's version of cash. Some are worried that this will drive Bitcoin businesses out of New York because they completely oppose the basic goals behind the currency itself.
Here's the thing. When you have that much money under the control of an individual or an organization, society then builds all of these regulatory institutions because they figured out that when you do that, those institutions, those organizations, those individuals steal the money again and again. When you put one person in charge of the money, they steal the money. I mean, that's what power corrupts. Absolute power corrupts, absolutely. And there is no more powerful corrupting influence than money. So when you have people who have millions in their control, bad things happen. Or they're sloppy with their security and somebody else robs them. But in either case, Bitcoin is a different solution. The idea is instead of collecting all the money in one big bucket, you have each user controlling their own money. You don't put it in a bank. You don't concentrate the risk. And that way, you don't need all of these elaborate controls because you don't take the control of the money away from the individual. You leave it in the hands of the individuals. Well, Mt. Gox took it away of the control of the individuals, but then didn't have any of the regulatory institutions that we traditionally have in banking. So they weren't using the Bitcoin security, and they weren't using the traditional banking regulations and audits to protect them. They were in this gray area in between, where they had all of the control over the money and none of the protections. Here's the other thing that's not going to happen. Mt. Gox didn't get bailed out. Mt. Gox didn't get 0% interest loans from a central bank in order to pretend they're solvent when they're not. Mt. Gox didn't make deals with other banks to cover up their losses by collateralizing them in CDOs. Mt. Gox didn't get to acquire some of the failing banks, add them to their asset sheet, and then pretend that they were not failing. Mt. Gox didn't get to bail in all of the customers of Bitcoin across the entire economy. Mt. Gox didn't get to hyperinflate the currency in order to save themselves but destroy the economy. No, all of those things happened after 2008.
Of course, this is an unfair comparison to make, but the satirical account of the situation definitely points out the biggest differences between digital currencies and the traditional banks, which is the fact that digital currency is largely unregulated, and that digital currency has only been around for a few years, while the banking system has been our economic backbone for decades, which is why it was able to get away with so much in 2008. This brings about the question, can financial technology really take over the traditional banking system, which is seemingly inseparable from our complex economy?
And we saw the same thing in the late 1990s. Relatively few of those companies persisted and disrupted established players, but a lot of them got bought by established players, and it did ultimately move the technology progress forward.